In 1973, 50 stocks convinced the entire market they were bulletproof. Coca-Cola, IBM, Polaroid, Xerox. Wall Street called them the Nifty 50, and the pitch was simple. Buy these companies and never sell because they're too good to fail. Investors didn't just believe it, they built entire portfolios around it on the theory that quality this obvious didn't need a valuation check. And by 1974, 13 of those 50 companies had lost more than half their value, dragging the S&P 500 down with them by over 40%. Here's the part that should make you uncomfortable. Right now, 7 companies make up roughly a third of the entire S&P 500's value: Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta, Tesla. And the story investors are telling themselves about why that's fine is almost word for word the same story they told in 1973. And if you've ever wondered why financial media keeps saying this time is different every single time a handful of stocks take over the market, hit subscribe, because that's exactly what this channel is for, pulling apart the pattern underneath the headline. Now, back to 1973, because the Nifty 50 isn't actually the scary part of this story. The scary part is what happens when the machines get involved. Start with the basic mechanic. A stock market index like the S&P 500 isn't 50 companies today. It's 500, but it's weighted. That means the bigger a company gets, the more it moves the index. When Nvidia goes up 3% in a day, it pulls the entire S&P 500 up with it, even if 490 other companies did nothing at all. That's not a conspiracy, that's just math. But here's where it gets interesting. Trillions of dollars are sitting in index funds. Vanguard's S&P 500 fund alone manages over $1 trillion, and index funds don't think. They don't analyze. They don't ask whether Nvidia is worth what people are paying for it. They just buy whatever the index tells them to buy in the exact proportion the index says to buy it, which means as Nvidia gets bigger, index funds are mechanically forced to buy more Nvidia, which makes Nvidia bigger, which makes index funds buy even more. You are watching a feedback loop, and feedback loops don't ask permission before they become a problem. Now layer in the AI part, because this is where 2024 and 2025 stopped looking like a normal bull market and started looking like something else. A huge percentage of the stock market's gains over the past 2 years have come from companies either building AI or claiming they will benefit from it. Nvidia's revenue from AI chips went from a rounding error to over $100 billion in the space of about 2 years. Microsoft, Google, Amazon, and Meta collectively pledged to spend more than $300 billion on AI infrastructure in a single year. And Wall Street rewarded every dollar of that spending with a higher stock price, on the theory that AI will eventually generate profits big enough to justify it. Notice the word eventually. That word is doing an enormous amount of work. Here's the blue-collar version. Imagine a construction company that keeps taking out loans to build bigger and bigger buildings, and every time they announce a new building, their stock price goes up. Not because the building made money yet, but because investors assume it eventually will. That works fine as long as everyone keeps assuming the same thing at the same time. The moment even a small percentage of investors stop assuming it, the buildings don't disappear, but the story does. And when the story disappears, the price was never really about the buildings in the first place. It was about everyone agreeing to believe the same thing simultaneously, which is a much shakier foundation than a building's actual concrete. That's the human side of the risk. The machine side is worse, because it's not just index funds buying mechanically, it's algorithmic trading systems, and they now execute somewhere around 70% to 80% of daily stock market volume in the United States. Firms like Citadel Securities and Renaissance Technologies aren't reading earnings calls and forming opinions. They're running code that reacts to price movement in microseconds faster than any human could read a headline, let alone react to one. When a stock starts falling fast, certain algorithmic strategies are designed to sell into that fall, to cut losses before they compound. That sounds responsible in isolation. The problem is that thousands of firms are running structurally similar code, reacting to the same price signals at the same time without any of them coordinating with each other. One algorithm selling isn't dangerous. 10,000 algorithms selling in the same 6 seconds is how you get a crash that has nothing to do with anything actually going wrong in the real economy. This already happened, and Wall Street has a name for it: Black Monday. October 19th, 1987. The Dow dropped 22.6% in a single day, the worst single-day percentage crash in stock market history. And it wasn't triggered by a war, a recession, or a scandal. It was triggered by an automated strategy called portfolio insurance, which was designed to sell stock automatically as prices dropped. to protect investors from losses. Every fund using it was following the same logic. Every fund using it sold at the same time. And the selling itself became the crash. The machines weren't reacting to bad news. The machines were the bad news. Regulators studied it for years afterward and eventually built in circuit breakers, automatic trading halts, specifically so that one algorithmic panic couldn't cascade into another one uninterrupted. Those circuit breakers still exist today. Whether they're fast enough for 2026's version of the problem is a different question entirely. It happened again in 1998, in a smaller but stranger way. A hedge fund called Long-Term Capital Management, run by two Nobel Prize-winning economists, used mathematical models to trade with so much borrowed money that when Russia defaulted on its debt and the models broke, LTCM's losses threatened to freeze the entire global financial system. The Federal Reserve had to organize a bailout. Not because LTCM was too big to fail in the way a bank is, but because its trades were so tangled into everyone else's positions that its collapse would have dragged down institutions that had never even heard of it. The lesson from both 1987 and 1998 is the same lesson, just wearing different clothes. When enough automated, interconnected systems are built on the same assumption, the failure of that one assumption doesn't stay contained. It travels. Now, stack today's AI concentration on top of that same machine infrastructure, except faster, bigger, and more interconnected than 1987 or 1998 ever were. If Nvidia, Microsoft, and the handful of companies driving this rally start to slide, even for a boring reason, even just a disappointing earnings call, index funds are mechanically forced to sell proportionally across the market. Algorithmic trading systems detect that price movement and accelerate it, and retail investors watching their portfolios drop start pulling money out of the same index funds, forcing those funds to sell even more to meet withdrawals. Nobody planned this. Nobody's in a room deciding to crash the market. It's just what happens when concentration, automation, and passive investing all point the same direction at the same time, running on infrastructure that moves faster than any regulator can watch it. If this is the kind of mechanism you want explained before it becomes a headline, the actual plumbing behind why markets move the way they do, not just the panic after it happens. The Sketchbook Finance newsletter breaks down exactly this every week with more detail than a 9-minute video can hold. The link is in the description below and it's free. Here's the part almost nobody talks about, and it's the third layer, so stay with this one. Even Federal Reserve officials have started flagging this risk directly. In recent financial stability reports, the Fed has explicitly named the concentration of the stock market in a small number of technology companies as a systemic vulnerability, not a talking point. An actual line item in a report meant to track what could break the financial system. That's not a YouTube channel being dramatic. That's the Central Bank of the United States putting it in writing, in the same document series that tracks bank capital levels and mortgage default risk. And the reason it matters more now than it did in 1973 comes down to one word: interconnection. In 1973, if the Nifty 50 crashed, it hurt the people who owned those 50 stocks. That was largely it. Pension funds existed, but they weren't wired into every paycheck the way they are now. Today, because of index funds, because of 401ks automatically invested in the S&P 500 by default, because of algorithmic trading systems that don't distinguish between your retirement account and a hedge fund's trading account, a crash in 7 AI-driven companies doesn't stay contained to 7 companies. It runs through the plumbing of nearly every retirement account in the country, because nearly every retirement account in the country is holding some version of the same index weighted toward the same 7 names, whether the account holder has ever heard of Nvidia or not. There's also a newer wrinkle nobody had to deal with in 1987. The AI companies are not just the ones being bought by index funds, they're also increasingly the ones providing the infrastructure that trading algorithms run on. Cloud computing from Amazon and Microsoft, chips from Nvidia, which means a slowdown in AI spending doesn't just lower those companies' stock prices, it can ripple into the operating costs and margins of the very financial firms whose algorithms are trading those stocks in the first place. The system isn't just concentrated, it's recursive. So here's the systemic problem, the one that ties every layer together. The market isn't overvalued because people are irrational. It's overvalued because every individual piece of the system is behaving exactly the way it's designed to behave. Index funds, buying proportionally is the system working correctly. Algorithms, reacting to price movement in microseconds is the system working correctly. Investors chasing AI growth because the profits genuinely could be enormous someday is not irrational. It's a reasonable bet on a real technology made by reasonable people. None of the individual pieces are the problem. The problem is what happens when all of those correctly functioning pieces are pointed at the same 7 companies, moving in the same direction, at the same time, with no mechanism built in to slow any of it down before the momentum becomes the story itself, which is exactly what happened in 1987, and exactly what happened, in a smaller way, in 1973, and exactly what nearly happened in 1998 before the Fed stepped in with a checkbook. The mechanism doesn't need a villain. It doesn't need a scandal or a fraud or a bad actor in a boardroom somewhere. It just needs enough automated systems pointed at a narrow enough target, and eventually something